Picture this. September 12, 1923. You're standing outside a butcher shop in Berlin, clutching a leather satchel filled with banknotes, not filled with groceries, filled with money. The butcher scribbles a new price on the chalkboard every hour. Last week, sausage cost 40 million marks. This morning, it's 300 million. By noon, it'll be 500 million. You think this is about politics, about the Treaty of Versailles, about national humiliation. You're wrong. This is about the balance sheet. This is about a government that tried to print its way out of bankruptcy and discovered a law older than empires. You cannot print wealth. You can only destroy currency. And when currency dies, only 5 things survive. Everything else goes to zero. We're taught that nations fall because of war, invasion, bad generals, corrupt politicians. That's the Hollywood version. The real version is written in ledgers. It's written in debt service ratios, in foreign exchange reserves, in the gap between revenue and expenditure. When a nation goes bankrupt, it doesn't matter how many tanks you have. It doesn't matter how patriotic your citizens are. Sovereignty is solvency. And when the money runs out, the nation follows. This has happened over and over. Weimar Germany in 1923. Zimbabwe in 2008. Venezuela in 2018. Lebanon in 2023. Different countries, different decades, same autopsy report. The currency bled out. And when it did, only certain assets survived. Let me take you back to the illusion of majesty. Germany after World War I was gutted but still breathing. The factories were intact. The engineers were still there. The industrial base that had nearly conquered Europe was bruised but not broken. On paper, Germany could rebuild. Except for one problem. The Treaty of Versailles demanded reparations. Not symbolic reparations. Real reparations. 132 billion gold marks. That's roughly 33 billion US dollars in 1921 money. In today's purchasing power, that's close to $500 billion. And Germany had to pay it in gold or foreign currency, not marks. Think about that. You've just lost a war. Your economy is shattered. And now you owe $500 billion in hard currency. But beneath the surface, the foundation was rotting. The German government made a choice. Instead of raising taxes or cutting spending, they printed money. They fired up the printing presses and flooded the economy with marks. At first, it seemed to work. Unemployment dropped. Factories reopened. Workers had cash in their pockets. But that cash was a lie. It was backed by nothing. And the moment foreign creditors realized Germany was inflating away its debt, they demanded payment in gold. Germany didn't have enough gold, so they printed more marks to buy foreign currency to buy gold. And the death spiral began. Here's the economic trap. Inflation is an addiction. Once you start, you can't stop without causing a recession. And politicians hate recessions. So they keep printing. By mid-1922, the mark was trading at 320 per dollar. That was bad, but manageable. Then it accelerated. By January 1923, it hit 17,000 per dollar. By August, 4.6 million per dollar. By November, 4.2 trillion marks per dollar. Let that number sink in. 4.2 trillion. A loaf of bread that cost half a mark in 1918 now cost 200 billion marks in November 1923. Workers were paid twice a day because money lost value by the hour. The antagonist wasn't France or Britain. It was the bondholders. It was the forex market. It was every German citizen who realized their savings were evaporating and fled to anything that wasn't marks. And when everyone tries to exit a currency at once, the currency doesn't just fall. It implodes. The Reichsbank kept printing larger denominations, 1 million mark notes, 1 billion mark notes, 1 trillion mark notes. They couldn't print fast enough. The paper was worth more than the currency printed on it. People used banknotes as wallpaper, as kindling, as toys for children. It was cheaper than buying actual paper. Now here's what most people miss. During this collapse, wealth didn't disappear. It transferred. If you held marks, you were annihilated. Total wipeout. But if you held certain assets, you survived. Some people even thrived. And that's the pattern we need to decode. Because it's happening again. It's happening right now in Turkey, in Lebanon, in Argentina, and the warning signs are visible in every major economy on Earth. So let's do the autopsy. Let's look at what survived when the mark burned. Asset number 1. Gold. The universal constant. During the Weimar hyperinflation, an ounce of gold bought the same basket of goods before, during, and after the collapse. The price in marks went parabolic. An ounce of gold that cost 100 marks in 1918 cost 87 trillion marks by November 1923. But that's just nominal price. In real terms, in purchasing power, gold held steady. It bought the same amount of bread, the same amount of meat, the same amount of housing. The currency changed. Gold didn't. This isn't theory. This is documented historical fact. People who converted their savings to gold before the collapse maintained their wealth. People who didn't lost everything. Fast forward to Zimbabwe. Between 2000 and 2009, the Zimbabwe dollar went through the same death spiral. Mugabe's government printed money to fund land redistribution and political patronage. Inflation hit 89.7 sextillion% year over year. That's not a typo. Sextillion. The government issued a $100 trillion banknote. It couldn't buy a loaf of bread, but gold held value. An ounce of gold bought the same basket of goods in 2000 that it bought in 2009. The only difference was the number of Zimbabwe dollars required to buy that ounce. First thousands, then millions, then billions, then trillions. Venezuela followed the same script. In 2008, $1 equaled 2 bolivars. By 2018, $1 equaled 248,000 bolivars. By 2023, over 30 million bolivars. The bolivar became worthless. But gold didn't. Venezuelans who held gold maintained purchasing power. Venezuelans who held bolivars watched their savings vaporize. And right now, in late 2024, we're seeing the pattern repeat in Turkey. Gold deposit accounts at Turkish banks surged from 1.36 trillion lira to 2.72 trillion lira in a single quarter. That's a 100% increase in 3 months. Why? Because Turks see the pattern. Runaway inflation, currency debasement, and they're fleeing to the only asset that survived every collapse in human history. Here's what gold critics don't understand. Gold doesn't need to do anything. It doesn't need earnings. It doesn't need a business model. Its entire function is to not be debased. When the supply of fiat currency explodes, the purchasing power of each unit collapses. Gold supply can't be arbitrarily expanded. It requires mining, refining, physical labor. So gold becomes relatively more valuable by default. Not because gold is magical, because fiat currency is being destroyed. During the 2008 financial crisis, gold initially crashed as liquidity froze. Everyone was selling everything for dollars. But once central banks started printing, gold surged 166% in less than 3 years. Silver did even better, 448%. Same pattern in the 1970s. Gold fell almost 50% mid-decade. Then it bottomed in 1976 and surged 440% over the next 3 years. The mechanism is brutally simple. Precious metals are insurance against monetary system failure. Not speculation. Insurance. You hold them because they preserve purchasing power when everything else burns. Now let's talk about asset number 2. Foreign hard currencies. When your domestic currency is dying, the escape valve is holding someone else's stable money. Let me take you to Beirut. October 2019. You're a school teacher. You've saved $30,000 equivalent in Lebanese pounds over 15 years. The pound is pegged at 1,507 per dollar. It's been stable since 1997. 22 years of rock-solid stability. Then the peg breaks. August 2019. Black market rate hit 1,600. April 2020. 3,000. March 2021. 14,000. By 2025, the official rate is £89,000 per dollar. Your $30,000 in pound-denominated savings is now worth $337. You lost 98% of your purchasing power, while the nominal number in your bank account stayed the same. But here's the kicker. Your colleague, another teacher, kept her savings in US dollars, physically, cash, outside the banking system. She maintained 100% of her purchasing power. Not because the dollar was magical. She could have used Swiss francs or euros, but because she held a currency that wasn't collapsing. This pattern repeats everywhere. Zimbabwe. The economy dollarized itself before the government made it official. People abandoned the Zimbabwe dollar entirely and started using US dollars for transactions. Shops refused to accept local currency. They demanded dollars or South African rand, anything but Zimbabwe dollars. Ecuador did the same in 2000 after a financial crisis wiped out the sucre. El Salvador in 2001. Panama has been dollarized since 1904. Venezuela right now. Venezuelans use dollars for major purchases even though the bolivar is still technically legal tender. You want to buy a car? Dollars. A house? Dollars. Appliances? Dollars. The government can mandate all it wants. People vote with their wallets. Argentina. You buy property in dollars, not pesos. Real estate contracts are written in dollars. Prices are quoted in dollars. The peso is just a temporary medium of exchange that everyone converts immediately. Cambodia. ATMs dispense US dollars, not reals. The banking system runs on dollars. The riel is almost a novelty currency used for small change. This isn't a policy choice. It's a survival mechanism. When domestic currency fails, rational people switch to stable foreign currency. The lesson is clear. Access to foreign currency during a crisis is complete protection. A person holding dollars during the Lebanese collapse maintained their wealth. A person holding pounds lost 98%. That's not market volatility. That's the difference between survival and annihilation. Now here's asset number 3. And this is the one that separates people who understand currency collapse from those who don't. Productive equities, stocks. Ownership in real companies with real assets. Here's what blows people's minds. Venezuela's stock market rose over 3,400% in 2024. The Caracas Stock Exchange surged from 2,082 points to over 6,000 in 9 trading days in January 2025. Individual stocks went parabolic. Mercantil Servicio Financiero up 200%. CanTV up 219%. Bancarib Provincial up 171%. You might think, wait, the economy is collapsing and stocks are skyrocketing? That makes no sense. Wrong. It makes perfect sense once you understand what stocks are. A stock isn't a piece of paper. It's ownership in real assets, factories, equipment, inventory, land, intellectual property. When currency collapses, the nominal price of those assets rises to match inflation. Not because the assets themselves became more valuable, but because it takes more currency units to represent the same real value. Imagine a Venezuelan manufacturing company worth $100 million in real productive capacity. When the exchange rate goes from 10 bolivars per dollar to 30 bolivars per dollar, the stock price rises from 1 billion bolivars to 3 billion bolivars. Not because the company got bigger, because it takes more bolivars to equal the same dollar amount. But here's the critical distinction most people miss. Not all stocks survive equally. Only companies with revenue streams diversified away from the collapsing economy maintain real value. A company earning 100% of revenue in bolivars sees its real profitability collapse even as its nominal stock price rises. Why? Because it has to convert worthless bolivars back to dollars to buy foreign inputs, to pay foreign suppliers, to import raw materials. Its margins get crushed. Conversely, a company that exports 50% of production receives dollar revenues directly. Its bolivar costs decline in real terms while dollar revenues stay stable. Real profitability improves during devaluation. For shareholders, this becomes an actual inflation hedge. Research on the Latin American crisis of 1982, Mexico's peso crisis of 1994, and Asia's meltdown of 1998 confirms this. Direct investors operating manufacturing facilities that could redirect sales from local markets to export markets survived and thrived. Other investment forms plummeted into negative territory. The key was export capability. Mining companies that sold commodities for dollars. Agricultural firms that exported to foreign markets. Technology companies with international clients. These survived. Domestic retailers, local banks, construction firms tied to the local economy. They burned with the currency. So the lesson. Productive equities with international revenue streams are not just survivors, they're beneficiaries of currency collapse. But domestic-only companies, they burn. Asset number 4. Consumables and barter goods. When the formal monetary system fails completely, economic activity doesn't stop. It reorganizes around different media of exchange. Post-World War II Germany. The Reichsmark was so worthless, it was effectively abandoned. People traded goods for cigarettes, coal, potatoes, coffee. Cigarettes became particularly prominent as a temporary currency. American soldiers bought cigarettes from army exchange stores for pennies and traded them with Germans for goods and services worth exponentially more. Why cigarettes? Standardized, easily divisible, non-perishable, lightweight, widely accepted. They had all the properties of money except one. A government didn't issue them. Black markets near train stations in big German cities operated 24/7, trading everything from railway tickets to forged documents. The medium of exchange? Cigarettes. 1 carton could buy a week's worth of food. 5 cartons could buy a winter coat. 20 cartons could buy jewelry or silverware. Here's the economic proof. When large backlogs of Red Cross packages arrived at POW camps, sometimes injecting hundreds of thousands of cigarettes into the camp's money supply at once, it caused inflation. More cigarettes chasing the same goods meant higher cigarette prices. Same mechanism as fiat currency expansion. The cigarette economy had its own boom and bust cycles. Fast forward to Venezuela 2018. As the bolivar became worthless, Venezuelans engaged in barter. Fishermen traded their catch for flour just to feed their families. Farmers exchanged vegetables for medicine. Doctors traded consultations for gasoline. Items that held value, medical supplies, food, water, fuel, batteries, soap. Anything with immediate consumption value or enabling essential functions. During supply shortages, even toilet paper and diapers became valuable. Not for comfort, for health. Staying clean prevented infection during systemic failure when hospitals had no supplies and pharmacies had empty shelves. But here's the limitation. Consumables are consumed. They can't serve as long-term stores of value. You can't build a portfolio on aspirin and batteries. They're tactical, not strategic. You use them to survive acute phases of collapse, to trade for necessities, to bridge gaps when formal currency stops functioning. But you can't hold a 20-year retirement plan in canned goods. They expire. They get used. They don't appreciate. The optimal allocation, a small portion in physical necessities for immediate exchange value during acute crisis phases. But the bulk of wealth in assets that don't evaporate when used. Gold, foreign currency, productive equities. Consumables are survival tools, not wealth preservation. Asset number 5. Agricultural land. The immobile store of value that produces the one thing humans cannot live without, food. During the Great Depression, farm families had a survival advantage. Urban households simply didn't. They grew vegetables, canned fruit, collected milk, eggs, and meat. They could survive without consumer goods. But they faced one brutal reality. Taxes and bank debts still had to be paid in cash. Many lost their farms anyway. Yet those who held on kept the ability to feed themselves. That alone mattered. Venezuela proved the same rule. Landowners who could grow food stayed functional regardless of currency collapse. Calories don't depend on bolivars. They depend on soil, water, seeds, and labor. Urban landlords, meanwhile, collected rent in money that bought nothing. Land produces calories. Apartments produce currency-denominated promises. Calories win. But agricultural land has vulnerabilities. First, it's illiquid. You can't move it. You can't sell quickly in a crisis. If ownership becomes unsafe, you're trapped. Zimbabwe showed this brutally when land was seized by decree. destroying farms and wiping out value overnight. Second, taxation. Land is visible and easy to target. Governments can tax it until forced sales begin. Third, crop type matters. Export crops paid in hard currency outperform domestic-only production. Agricultural land isn't perfect. It's not flexible. It's a survival asset, and survival assets always come with trade-offs. Now let's talk about what goes to zero, because knowing what fails matters as much as knowing what survives. First, fixed income assets in a collapsing currency. Bonds, treasury notes, any promise where you're a creditor to a failing state. In Weimar Germany, bondholders were paid in marks that couldn't buy a stamp. In Argentina, debt restructuring slashed values by 70%, with years of legal battles for pennies on the dollar. The contract was honored. The value wasn't. When a currency collapses, fixed income collapses with it. Second, domestic savings held inside broken banking systems. Lebanon is the textbook case. Deposits denominated in pounds lost over 95% of purchasing power. Nominal balances stayed the same, but the value vanished, and capital controls trapped people inside the system. Money you can't use is money already gone. History is unambiguous. Being a creditor to a failing state is the fastest path to total wealth destruction. In hyperinflation, debt gets repaid in worthless paper, while real value is erased daily. The warning signs are visible: currency flight, bank distrust, capital controls. Iraq shows early stress. Turkey shows currency substitution. Lebanon shows full collapse. This isn't theory, it's pattern recognition. When currencies fail, promises die with them, and only real assets remain.